battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to another episode of the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Episode 144. Hard to believe we are back at it in the thick of March Madness. That's the title of this week's show and episode, March Madness 2024. Here we go. The market is at another record all-time high, 52.50. Aren't you glad you stayed the course? You didn't panic. If you've been listening to our show, if you've been getting the articles, reading our research, if you're our client, you know we've been keeping you on your plan, not getting distracted by the media doom and gloom, getting off our plan, panicking, selling at the bottom. We're not doing any of that here. We're trying to keep you on your plan and make sure that you don't sell your stocks when everybody else is panicking. And here we are. Market's at a record all-time high. Took us a few years to get there. That's okay. Sometimes that happens. We're in a rising rate environment. Now it looks like we're going to be at peak rates, at least according to Jerome Powell. We'll see if that actually comes to fruition. Don't forget, he is the guy who called inflation transitory. So take everything he says with a grain of salt. Sorry, Jerome. You missed it the first time. So we'll see if you can get it right this time. I have my doubts. We'll see. But the Fed did come out yesterday on Wednesday and say that rates are going to go lower at some point this year. Still about 3 rate cuts priced in. I don't think they're going to be massive rate cuts. I think they're going to be a quarter point, maybe a half a point later at the end of the year. But the Fed doesn't have a whole lot of reason to cut aggressively yet because the economy is still firing on all cylinders. Now, the inflation situation is not good. The Fed made up a brand new made-up number called super duper CPI, which takes out housing, food, and energy. And you're like, wait a second, isn't that all of the costs that I incur on a weekly basis or a monthly basis? The answer is yes. So again, this is government engineering, not telling you the whole story. I always tell you, get yourself out in the economy, go see it for yourself. Who are you going to believe? The Fed produced numbers or your lying eyes? Inflation's here to stay. I've been out, been traveling, going to Houston, visiting with clients. I'm at CERAWeek just a couple days ago in downtown Houston. It's booming. 7,500 people. It's not a cheap ticket either. I will tell you, I didn't actually attend. I just stopped by, said hi to a friend who was attending, and it's booming. Everywhere you go, the restaurants are packed. The cruises are full. The planes are full. Everybody is spending money. The car dealerships are still not doing a lot of discounts. They say that demand is still strong. Obviously, there's no housing inventory, so housing prices are still strong. The builders are having incredible amounts of problems because remember, higher rates don't just hurt you and I, they hurt builders too. So we're just not getting housing inventory. What does all that add up to? More inflation. So Powell, I believe, is going to end up like the next Arthur Burns in the 70s. Remember, Arthur Burns did not have the guts to keep rates high. He cut too early. Inflation came roaring back. I don't know exactly if that's going to happen this time. I think we're in a little bit different of a situation in the 70s. Back in the 70s, U.S. economy was very, very heavy on industrials, manufacturing, textiles, and we're a lot different today. We're a services economy. We're a people and information economy. That's the good news. And so inflation really has not hurt people like a lot of economists expected because of that, because we are a services economy, but also because there's just so much cash on the sidelines. People are paying off their mortgages. The baby boomers that hold most of the wealth are actually in really good shape. And 5% interest rates are almost like a stimulus for people who have cash rather than the effect the Fed was hoping they'd have. All that to say, we're not ignoring the people in the lower and the middle income groups. Very, very sad what's happened there. Those people are struggling. And so the government that tells you we are going to help the little guy always ends up stomping out the little guy. I would take you back to what Ronald Reagan said, the scariest words in the English language. I'm from the government and I'm here to help. Next time you hear that, make sure you run out the door as fast as you can. Scariest words in the English language is the government trying to fix problems. And remember, they're trying to fix the problems that they created. '08 and '09, great example of this. It was a crisis, and you'll remember Rahm Emanuel famously said, "Never let a crisis go to waste." Well, '08 and '09, we certainly did that. We took advantage of the banking issue that I believe, according to Brian Westbury at First Trust Portfolios, who pointed this out, was caused by mark-to-market accounting, a government rule. And when mark-to-market accounting was reversed, the economy basically righted itself. Stock prices went back up to record all-time highs. And then we took control over the banking sector. Banks are basically, they're not nationalized here like they are in China, but there's a lot of control consolidated at the Federal Reserve level. Each and every time we have one of these crises, we are essentially getting to the point where we respond to a crisis that was created by the government with more government overreach and power. And that's why we continue to tell you from an investment standpoint, it's all about large caps. It's all about the big companies that can deal with higher regulation, that can deal with higher compliance costs. And that's certainly what we've seen the past 5 years. Large caps, especially the top 50 of the S&P 500, have outpaced small caps almost 3-1. Not quite, but it's pretty close to 3-1 outperformance of large caps over small caps. I think that's a trend you're going to continue to see happen. Now, before we go any further, I will just hit pause on that and say, we're watching some news come out from Apple. You're seeing Apple get examined by the regulators. They want to break Apple up, possibly saying it's a monopoly. I don't know if Apple really gets broken up. It takes a lot of willpower in Congress for this to happen. And so far, our current divided Congress doesn't seem to have a huge appetite to do this. But they are going to probably fine Apple a boatload of money. That's what the EU regulators have done. They fined big tech companies to death. And Meta even got to a point where they said, you know what, we're not even going to offer part of our services in the EU anymore because it's just not worth it. And so all these regulatory charges are levied against these big companies. They may get to the point where they want to spin off certain divisions anyways. And I've told you, I'm not worried about spinoffs. I'm not worried about breakups. You remember Standard Oil way back in the day, and the pieces of Standard Oil, Exxon and Chevron and Conoco and some of the other ones are actually more valuable on their own than they would have been together, get higher multiples than they would have together. You could see the same thing happen with big tech, whether it's Apple or Amazon or Microsoft or Meta or any of these big tech companies, where they spin off YouTube, for example, from Google, and that becomes worth more than it would have been in the Google structure. Or you spin off the AWS business from Amazon, and that's a completely a different animal than the overall Amazon business is today. That's what powers all their growth, quite frankly. So I'm not overly concerned about that story. It's not great. It's not fantastic news. But again, these companies are sitting on record stockpiles of cash. They can deal with this stuff when it comes up. They can deal with what's gone on. And that's not something we have to like. We don't have to like that the biggest companies are the biggest and can deal with the regulation, that the government stomped out the small entrepreneur. That's just a reality of the situation we're dealing with. What's come to the rescue of the small business and the entrepreneur, and what's come to the rescue of the overall economy? The answer is technology. And if you don't know the stories of the technology going on behind the scenes, go subscribe to some of these tech journals, subscribe to the scientific journals. You got to know what's coming, because that's where you're going to get your excitement for the future from, your optimism from. You go, Nick, how come you're always bullish and optimistic? Well, first of all, we're not always optimistic and bullish and just bullish for just for fun. We're bullish because we actually know what's going on underneath the surface. There's a lot of unbelievable things coming down the pipeline with technology, from AI to machine learning to robotics to process automation to the cloud. All these different transformations. I believe we're in the early stages of this absolute tech boom that our country has just not even can't even comprehend what's going to happen here. Now, you may hate the fact that Elon Musk, for example, is putting Neuralink chips into people. Fine, I understand where you're coming from, and I'm not saying I'm going to get a Neuralink chip. I probably never will do that, quite frankly, but it is pretty interesting that we have the technology to do stuff like that. That's what is coming. And Tesla is on the cutting edge of this. Elon Musk is on the cutting edge with Starlink and sending satellites into space. And all this technology, I believe, is a miracle. And I truly believe that technology and ideas and business formation and cap and wealth creation come from God, quite frankly. I think, without these ideas that we've had, without this innovation we've had in entrepreneurship and technology, the world would be just a much more miserable place to be. I'll go back to the conference I stopped by, CERAWeek in Houston, and there are a lot of people there that come from a climate lens. I understand that. I understand everybody wants a cleaner world. I don't think there's anybody out there who doesn't want to live in a cleaner place and environment, but we disagree on how we're going to get there. Are we going to do it through wind farms and taxing people's carbon emissions and telling people they can't have a cow because cows fart too much? It's ridiculous. And so I think the reality of what's gone on at some of these U.S. energy companies like Exxon, like Chevron, Conoco, is just incredible. The entrepreneurship, the level of innovation at these companies. Many of these folks are our clients, the PhDs, the researchers, the engineers, the people who are working the problem to say, how are we going to get the world to a better place that we all want to go to? But how are we going to do it with entrepreneurs leading it, not governments trying to control everybody? That's the real key. And once you meet these entrepreneurs and figure out what's going on, and you meet these engineers and you meet these innovators, you just get excited. You can't help but be optimistic because they're going to work every single day to figure out solutions to problems. And so that should excite us about the future of the economy and the country. Now, stocks, and I'm going to say something that may sound a little weird to you or backwards, maybe even a contradiction, but stocks, I believe right now, are starting to enter overvalued territory. Remember, we've divided the groups into 3 groups of where stock prices can be. They can be overvalued, they can be undervalued, or fairly valued. I said for a while that I thought stocks were fairly valued. Last fall, I said stocks were undervalued. When the S&P was at 4,200 points and 4,400 points in October last year, we told you in that episode, an article, Buy Baby, that you should be buying stocks. Stocks are cheap. And sure enough, the market's up about 21% since we made that prediction. Okay. So then I pivoted and I said, okay, I think stocks are fairly valued. When they were trading at 20 times earnings, we're about 20 times earnings now, maybe just a touch higher on the S&P. We're a lot higher on the top 50 stocks. We're closer to about 24 times earnings, which is still not radically overvalued, but it is a touch overvalued if you look back at the past 5-year average. So we could stay overvalued on the S&P for a while. And this is where it's going to sound like a contradiction, what I'm about to say, is don't sell. Don't get out of your equities, because there's no possible way that you are going to time and know when to get back in. So you say, all right, Nick, you think the market's just a touch overvalued. Why don't I sell? Why don't I take some profit and I'll go sit in cash for a while until the market becomes undervalued? Well, the problem is there's no hard and fast rules on how long the market can stay undervalued or how long it can stay overvalued. We could stay overvalued for a while as long as earnings kind of keep pace with valuations. And by the way, if we have interest rate cuts and the Fed really does process the cuts that they say are coming later this year, you could see stocks become a lot more overvalued for a lot longer before we have a major recession or correction. And so stay on your plan. Don't try to time this thing out. Don't try to prepare for it. But what we are doing, and if you've noticed this, if you're our client in the portfolio, we're just starting to take some profits. There's a couple of companies where we might be up 100%, we might be up 80% or 300%, or in the case of NVIDIA, 500%. Of course, we're going to start taking some profit if some of these companies have become a bigger piece of the plan than they really should have been, because we don't want to expose you to unnecessary concentration risk. So that's what you do in these times. But it doesn't mean you go sit in cash. And here's why. The answer is because there's so many other companies outside of the Mag 7 that are actually cheap right now. And I won't name too many names here, but I do think there's a number of companies in the financial services sector, in the industrial sector. I think there's a couple of companies in the healthcare sector that are undervalued. And so instead of taking money from big tech and just sitting in cash and waiting for a correction, you should be going out and buying some of the companies that haven't performed. Quite frankly, Apple hasn't really performed this year. Apple is trading down, and we think is, not telling you this as an investment advice on an individual plan, but We do think that Apple is starting to get undervalued. We think Tesla is getting undervalued. Again, not a buy or sell recommendation, but my point to you is that there are always companies to buy, and there's always a way to make money in the market. You just have to be rebalancing, and that's what we do. So we are processing small rebalances here along the way as stocks exceed our expectations. At some point this year, we'll have a correction, and we'll do that even more. We may even take 5% from a treasury fund or a treasury part of your portfolio and put that into stocks. And so over time, if you do that rebalancing, you'll be fine. You'll buy some a little high, you'll buy some a little bit low, but in the end, stocks go up more than they go down. In fact, you have a better chance that the stock market is up double digits in any given year than down any amount. Let that sink in for a second. You have a better chance stocks are up double digits than down any amount. I like those odds. Those are pretty darn good odds, especially if you are going to be on a long-term plan. And so I believe stay in the stock market, stay in equities. Equities are your best hedge. And by the way, the politicians keep buying more stocks. They seem to be really good at the stock market game, especially our friends like Nancy Pelosi, who somehow has turned a $200,000 salary into a $200 million net worth. So maybe she knows something we don't know. All I can tell you is she's in the stock market. You probably should be too. So stay on your plan. Don't panic. All right. Here's the March Madness component of what we're talking about this week, and we'll wrap up on this. We're due for a pullback probably this spring. It may not be this month. It may not be April. It may not be May, but it's coming. The Fed is walking a tightrope. And if you watch Powell's speech yesterday, he continues to hammer this point home that the Fed has a dual mandate. What's their dual mandate? Number one, it's to have full employment. So have as many people who want a job working. Then at the same time, it's to keep inflation at a 2% target. You're asking yourself, Nick, where did they come up with the 2% inflation target? Your guess is as good as mine. Nobody knows. Nobody's sure where that 2% came from. And quite frankly, the Fed did come out and at one point said they might be okay with 3%. And so you're asking yourself, why is it that the Fed mandates we print 2 or 3% more inflation each and every year? Why can't we just have a stable monetary supply? Well, good question. And it's a question that you should ask Richard Nixon when he abandoned the gold standard. It's a question you should ask FDR when he outlawed the private ownership of gold. Why? Because the Fed enables politicians to do things that they could never do unless they had unlimited amounts of money. And that's why we have a 2% inflation target, because it essentially allows banks to print their own demand. I did an article in a show not too long ago. I believe it was in the fall or even the winter of last year. You could go on our YouTube channel and take a look. It's called something to the effect of, I just can't remember the exact title, but it was something to the effect of big banks getting bigger. And sure enough, since we put that article out, JP Morgan's up 50%, Bank of America's up 50%, Wells Fargo's up 50%. The biggest banks have just absolutely decimated the smaller banks. Why? Because there's a part of the economy that's driven by the Fed so significantly to the point where each and every one of these Fed meetings is almost like a Super Bowl, or it's the Final Four tournament. And what I mean by that is every time Powell goes on camera, all eyes are on Powell. It did not used to be like that. And in fact, when we had a scarce reserve model where the Fed only had about $1 billion in assets on its balance sheet and banks had $9 billion, that's all flipped now. I'm sorry, trillion. That's all flipped now. What's happened is everybody treats the Fed like it's a Super Bowl event, like it's the biggest thing that's ever happened. Why? Because the Fed has so much control over our day-to-day lives. And so the implication as investors is to do a couple things. Number one, equities are your best hedge. Why? Because if you're a company and your input costs have gone up 10 or 12%, you're not going to sit there and take 10 or 12% less profits. What do? You raise your prices 10 or 12%. And that's why money printing never works in the long run, because there's always a price to pay. There ain't no such thing as a free lunch. And monetary printing more dollars in the economy results in less purchasing power for you and I. And so that house down the road from you that just sold for 45% more than it did 4 or 5 years ago is not going down 45% anytime soon because your dollar buys less house. Again, that's Brian Westbury at First Trust who pointed this out. It's all about purchasing power. And so equities are that hedge that no other asset class can provide. Even better than gold, better than silver, better than buying a bunker and filling it with canned food, which I consistently tell you is not the way forward. I sympathize with you. You're thinking, Nick, the world's coming to an end. I am going to go live in the middle of nowhere in Wyoming. Good luck, because eventually you're going to have to go to the store and buy food, and they're not going to be taking your gold bars. They're going to be taking US dollars. That's the issue, is in reality, doom and glooming doesn't work. As much as we want to do that, and that might be built into our nature, quite frankly, we can't do that because it doesn't work in reality. So number one is to stay in the equity market. Don't panic. Don't worry. Equities over time, if you pick the best stocks and pick the right companies, and the top 50 is probably the easiest way to do that, quite frankly, you'll be fine over time. And then the second piece of this is just be careful with fixed income. I still do not believe that fixed income is priced correctly. You're thinking, Nick, the stock market is overvalued. You just said it yourself. And by the way, I'll just remind you, I said slightly overvalued, not radically overvalued. It's just slightly overvalued. I think bonds are actually more overvalued than stocks. Part of the reason for this is if you look at the 20-year treasury this year, it's down 5.5% price return when the Fed is still saying we're going to cut rates 3 times. So what's happened is bonds have rallied far above what their value could support. And now prices are coming back to reality. The problem with bonds, though, is if you go down 10 or 15% on a bond, it's just math. It takes a long time. It could take you years to break even, especially after you factor in inflation, you factor in the real return, which is the stated nominal return minus inflation, which the Fed says is 4%. So if you want to believe them, you're getting 5% on a bond. Your inflation rate's 3 to 4, at least. It might be more than that. So your net return's 1 before taxes. Hard to make a case to own long-term bonds here. I still think long-term bonds are overvalued, and that's why we've kept you in short-term, high-quality treasuries. I can get 5.25 or 5.5% on a 30-day treasury. I'll take that all day long until we really see what happens with the bond market and interest rates. That's number two. And then the last piece of this is I do think from a personal financial planning standpoint, we are looking at some degree of layoffs this year. I keep hammering this point home just to say credit card debt is rising. Consumers have more credit card debt now than they did 4 or 5 years ago. We paid the credit card debt off during COVID with the free cash that was handed out. And now those balances are going up because people got used to elevated lifestyles. If you're our client, my warning to you is just be careful here. Watch your spending, watch the debt load, watch what you're putting on. If you're putting money on credit cards, get them paid off. Watch some of the unnecessary purchases, because I don't think we've fully appreciated the fact that we're still burning off excess money supply that's happened the past couple of years. So just be careful. Prepare for a rainy day. Don't overextend yourself, because at some point there will be a reckoning. The cash that came in during COVID is going to come back to normal, and we will have a correction. There will be a recession at some point. I don't even think it's going to be this year or next year. It could be well into the future. But when it happens, just be ready for it from a standpoint that you don't have excessive debt. You aren't overextending yourself on your lifestyle. Just be careful, because I do think that companies, if rates stay higher for longer, are going to process some layoffs. So that's the last piece of that. Now, one last story to wrap up here is China. I think there's some significant cracks forming in China. I have been on the China thing for a long time, covering this well before anybody else did. You can go back over years of articles and episodes we put out, and I have told you, I think China's a paper dragon. I think there's a lot more problems going on in mainland China than any of us can truly understand. They tried to sort of shut down the doom and gloom stories about Evergrande and all the real estate blowups. I think that's just getting started, quite frankly. I don't think we know the full story, but part of the way that I think we can track this is look at the luxury goods manufacturers. Look at the LVMHs of the world, Louis Vuitton. Look at the Ferraris of the world. Look at all these luxury goods manufacturers and the numbers they're putting out. they're all saying there's a significant amount of softness or weakness in China. They're not reporting that in any other place. They're still reporting growth in the US. They're still reporting stability in Europe and Japan. But in China, they're reporting significant weakness, a significant sell-off in some of their goods. And so I think that's a canary in the coal mine, just to remind you, be careful. If you own a lot of Chinese equities, and you may think, Nick, there's no way I own Chinese equities, I would never do that. Well, just make sure you're looking at your 401k. If you got a target date fund, there's a good chance you've got some significant Chinese exposure in there. And that's what we can help you with. We can help you just identify that risk and make sure that you're not overexposed. I think China, and it's been like this for 5 years now, is going to continue to be uninvestable. We don't ever get the full story out of China. We never really know what's going on. But the only thing I do see from a instantaneous data standpoint, at least every quarter with company earnings reports, is that there's consumer softness, and we're not seeing that anywhere else in the world. The US, the consumer is very strong. China seems like there's maybe some cracks emerging. So be careful there. I think we're going to see some volatility in China continue. And I do think they're going to try and annex Taiwan at some point. That could be the canary in the coal mine as well, that maybe send some ripples through the global financial markets. But again, it won't last forever. It'll be a news story for a couple of months. We'll get through it, and stocks will be just fine in the long run. So we're still bullish. We're still optimistic. I do think stocks could continue going higher from here for a little bit, but we are due for a correction. We are slightly overvalued, but stay on your plan. Don't let that don't get nervous about that. Don't panic. And I do think we're going to have a continued opportunity to keep buying more as the market goes through a correction cycle later this year. Thanks for being with us. We'll see you in a couple weeks, April 17th at Gibson's in Oak Brook for our Wealth Insights Forum, doing a live podcast. We're filming Bullish on stage in front of a live audience. Get on that reservation. We only have about 20 spots left, so make sure you sign up right away for that. And then a week after that, we'll be at Trulux in the Woodlands, seeing all of our families in the Houston area. Can't wait to see you at that. I believe that one's very close to being full as well, maybe 4 or 5 spots. Thanks for being on the show. Go subscribe on YouTube, Apple, and Spotify. Helps us get the show to more and more people. And we'll see you next week for episode 145.